Hello and welcome everyone to the Manulife Investment Management webinar. Today, our topic is asset allocation. I'm Grace Ho, Chief Marketing Officer in Asia, and I'm your moderator today. Before we begin, just a quick housekeeping note. During the webinar, you can type questions in the space below the screen, and then we will take those questions after our session. Now, let me introduce our speaker today, Mr. Luke Brown, Head of Asset Allocation Asia. Luke is based in London. Thank you, Luke, for taking the time to join us today. How are you?
Delighted to be here, Grace, as ever. Good afternoon, everybody. Very much looking forward to today's discussion.
Great. Now, we were just talking about it before the session starts. The first half of the year unfolded in a way no one could have forecasted. The central bankers have faced unprecedented challenges. So not so long ago, we have seen the bottom of the stock market and the peak of the stock market and then correction. So can you please share with us a recap of the recent situation?
Yeah, of course. So look, I think it's absolutely the right place to start. In many ways, you know, if anybody on this call had been locked away for 6 months or on a desert island and had no idea what was happening, you would wonder what all the fuss was. We sit here today with equity markets again touching all-time highs. However, it is critical to understand the journey that we've been on, because that's going to inform the destination that we see over the rest of this year and beyond. So we have a chart here that we can pull up for you just to show the evolution of US equities in this case. So this is the path of the S&P 500, and this is from the beginning of the year till now. What we've also done, we've included in here what we believe are the key elements that we should be looking at. So broadly speaking, we can see at the start of the year, equity markets were grinding higher. We had positive news over US and China with the signing of the phase 1 trade agreement. However, as we all know, going through February into March, we then see the advent of the coronavirus pandemic. Now, this pandemic, as we know, has led to shutdowns across the globe, a collapse in economic activity, and quite frankly, material concern that we could be on a path to a depression-like outcome. As we go through March, you can see this precipitous decline led to some pretty extraordinary activity. The Fed was first to move. Emergency rate cuts kicked in. Already we started to see a degree of shift in sentiment across the investment community. And once the Fed had announced that they were going to pursue unlimited bond buying, that was really, for me, the catalyst of the bottom of the markets. The outlook then shifted from, okay, we have a global shutdown, but we have what is apparently a message of unlimited stimulus and liquidity. What does that look like going forwards? We then started to see action not only on the monetary front, but on the fiscal side. Congress agreeing a $2 trillion stimulus package. And I think, you know, it's important to pause here and just think of the sheer scale of the numbers that we are talking about. Trillion is the new billion. Okay. As we go through May and June, we are seeing this aggressive recovery. And then critically for me, we saw what I think is a manifestation of a much more coordinated and concerted effort from the central banks and governments across the globe. The European Union announcing their 750 billion euro recovery fund. The Fed's then going on a bond purchase program to stabilize the investment grade bond market. And that also then has knock-on effects into lower stratas of the credit class, including high yields. Notwithstanding this, obviously, COVID remained and still remains in the headlines. We saw the number of infections past 10 million. We saw the economic data coming out as expected, showing an extraordinary decline in activity. The sheer numbers of unemployed, some 22 million in the US, I think really brings context to the challenges faced by the central banks in addressing these issues. Defensive assets put on a particularly strong turn. I'd already mentioned the Fed's activity in reducing rates, leading to strong outperformance from US Treasuries. But then we also saw assets such as gold having dramatic increase in prices as people look to rebalance their portfolios, seek diversification, and then looking forwards, perhaps even start to think about what the outlook might be in terms of inflationary pressures, ongoing stimulus, and as I say, that fiscal side that is really pushing things. Now, where we sit now, we've just had the Fed approving a shift on their inflation targets, and being pretty clear to my mind that they will be pursuing full and effective employment as a primary objective, and they are prepared to allow inflation to float around a little bit. So it is their attempt, I believe, to try and reinflate and re-stimulate the economy. Now, the key thing to watch as we've gone through this cycle is the expectation and outlook people have in terms of how accurate and how fast that recovery is going to be. Is it going to be V-shaped? Is it going to be W-shaped? We now have people talking about a square root sign, a Nike swoosh. I think that the velocity of recovery has been strong, but we are looking carefully at numbers as they come out. The recent job numbers, for example, in the US indicate that while things are reopening, while progress is there, I'm starting to see the early signs of what might be a less rapid acceleration out of the collapse that we saw.
Right, thank you. I think very interesting, your comments about the bond market, as well as you touched upon the inflation pressure. I think we'll come back to these points later on. Now, of course, I think what investors care about is how these translate into asset allocation decisions. So can you please share with us the team's asset allocation strategy for the next 5 years, so a longer term horizon? And shall we start with the positives and then the less positive?
Yes, of course. So look, from a strategic side, and what I always try and do, and what we do as a global team in positioning our clients' portfolios, is make sure that we understand the objectives that we are trying to achieve. For many of our investors, the focus is on that longer term investment horizon. So our strategic framework, which is focusing, much more on how we see markets and asset classes evolving over the next 5 years. From the positive side of the spectrum, and I think, we can quite readily break these up into equities and fixed income. From an equity point of view, we are much more constructive on emerging markets relative to developed. Within Asia, we believe that Asia ex-Japan equities offer better opportunities for returns than those allocations in the US and Europe. We do like, on the fixed income side, more emerging market debt, and that will be a preference over US high yield and loans. One feature of this, of course, is that there's a particularly attractive carry that we can take advantage of. Now, also on the strategic side, I think it's important to look a little bit beneath the bonnet of broad asset classes. So, for example, in equities, we need to look at whether it's growth orientated or more value, etc. Now, at the moment, we still believe that there are great opportunities for the growth stocks. And these, of course, have been a driver of outsized returns in tech-heavy indices and countries, and that's why the US has done particularly well of late. If I look at it on the less constructive side, I think from a strategic point of view, allocation to government debt in particular is a challenge. The reality is that with so many governments now pursuing a zero or indeed negative interest rate policy, I'm less inclined to allocate to asset classes where effectively I am paying a government for the privilege of lending the money. That doesn't make intuitive sense to me. At the same time, we're looking very closely at the US dollar as a currency, having been very strong, and clearly, as the sort of default reserve currency in the globe maintains that key demand that underpins its strength. But we believe that from a strategic point of view, allocating away from US dollar denominated assets, and again, this lends itself to emerging market, local currency, Asian assets, should serve our clients well. Now, just one final thing in terms of the allocations that we hold and how we think about our portfolio construction from a strategic point of view. We do hold investment grade credits. We do hold certain high yield exposure, but obviously we need to be nimble in how we're thinking about this and make sure that the allocations that we take reflect not only our strategic outlook, but as we think about more tactically how we want to tilt those portfolios to navigate the changing macro landscape or indeed price evolution of those assets.
Right. So just to make sure that I understand you correctly. So from a geographical point of view, you're more positive on emerging market, especially Asia. For fixed income, you're more positive on emerging market debt over US market. And then from a style point of view, in terms of equities, you have a slight preference for growth style equities. And you're less positive on government debt because of obvious reasons that you've mentioned. And also the currency, you are slightly more positive on EM currencies. Now, thank you for that. And I want to go back to the bonds question, the fixed income question, because it is an important part of the asset allocation piece. You mentioned that it doesn't pay to own government debt. So do you think that fixed income still has a role? What kind of role the fixed income asset class play in the portfolio construction piece then?
Yeah, look, fixed income clearly has a critical role to play. For me, it's about selecting the right fixed income depending on the utility you'll have in your portfolio. For benchmark relative portfolios, typically you have an anchor in terms of duration or credit exposure. So maintaining that benchmark relative view, but at the same time, using the skilled managers that we allocate to add value by taking decisions over what part of the credit curve they want to be in, which selective credits are going to add the best value. Now, equally, the utility of fixed income, and we can talk about government securities. The reality that US Treasuries, for example, are not particularly attractive to us on a strategic view doesn't mean that we don't hold them. It just means that we see opportunities to exploit allocations in a risk sense where we can outperform that neutral allocation to US Treasuries. I would also think about it in terms of diversification and portfolio outcomes. Historically speaking, diversification has been a key driver and success in asset allocation portfolios. That's likely to continue, but I do feel that understanding how correlated asset classes are and where you need to look in different elements, different factors and different styles is critical to maintain that diversification on a forward-looking basis.
Right, thank you. And now what about for the shorter term? Because there's a lot of volatility, a lot of noise in the market. What's your view about the next 3 months asset allocation decisions? How do you think about them?
Yeah, look, and the tactical view, obviously, again, critical in delivering our client outcomes. What we attempt to do is position our portfolio, taking into account the shorter term views that we have across the team. There is, of course, a lot of active debate and discussion, and we benefit from the fact that, we have local representation across Asia, Europe, North America. And those global views, I think, hold us in really good stead to understand not just the top-down macro view, but that bottom-up local experience. So from that side, we do remain positively disposed towards risk assets. Broadly speaking, across portfolios, we remain overweight in many equity markets. The US has remained an overweight for now, but as I say, we're kind of getting to an inflection point there where I suspect that should US equity markets continue on their path upwards, we might look to trim risk there and reallocate it, for example, into emerging, where we see greater opportunities for growth. Now, from a fixed income point of view, we do like high yield from a certain point of view. Where I say a certain point of view, we've obviously seen a dramatic recovery in high yields, i.e. spreads tightening over the past 6 months. I still like the carry. We still have selective exposure, but again, cautious optimism, I think, on the path of high yield. And again, that might be an opportunity to switch out of US holdings more into the emerging side. And within that, I think China in particular offers us a very good opportunity. So if I just then sort of try and boil this down a little bit more for you, at the moment, the way we see things from equities across the regions, as I say, maintaining that overweight to US at the moment. Our view on Europe and Japan remains neutral. We don't have particularly strong conviction in the path of those asset classes or in equities. From a sectoral point of view, technology, as we know, has still been performing incredibly strongly. But we are looking more and more into the cyclical sectors such as financials, industrial materials, small caps, etc. The topic of growth versus value is one that is debated at length, and there are many conflicting views here. I think centrally the view that we have is that growth is going to continue to be a driver. US tech stocks, and I think also, again, looking specifically to Asia, clearly there is a huge sort of grounding in growth and tech factors that we can draw from China, across Asia, and specifically from Korea. We'll be reviewing these positions as we always do very regularly, and depending on how markets perform over the next few weeks, we could see a meaningful rotation there. Right. I'll just quickly touch on the fixed income side to cover all the bases. So again, from a shorter term point of view, we do like US and international treasuries. Okay, and bear in mind this is the tactical view, because as we're seeing, elements of curve steepening, for example, coming from the US, we can take advantage of that by taking exposure to longer dated positions. And then credit spreads, we still remain constructive on those from a tactical point of view. The reason for that is, as I mentioned in the introduction, we do have extraordinary support from many governments, and that is sort of holding the prices of investment grade credit from a global point of view up and being particularly strong. Just a couple of other views to complete the picture, because of course it's not just about equities and fixed income. We try and allocate as diversely as we can. Precious metals, gold, as I mentioned, has seen a meteoric rise, touching $2,000. We did have selective exposure in gold, and we have taken profit on those positions. I think, where we've seen a bit of a recovery, gold, silver, precious metals do offer us utility in portfolios, both from a return perspective, but also in potentially introducing some defensive characteristics should we see an increase in volatility in markets, which I think is more likely than not over the next quarter, simply looking at the horizon and the various factors that we have that could influence the prices of assets. Right.
So I think multi-asset portfolio, you have a lot of options and a lot of asset classes for you to exploit opportunities. And you've talked about in the tactical views, you are still looking at growth. In terms of equities, you're still looking at growth and see where is a good place to be in. Whether if it goes on any higher, you might look at trimming the positions back a little bit. And then on fixed income, you have tactical views on the US international treasuries. And then, of course, in precious metals, you have a tactical view as well. So that's very informative. Thank you. Now, I think going back to the previous point that you made about inflation pressure, do you want to elaborate a little bit more about the inflation, the point about inflation, the risk, or what you're thinking about?
Yeah, absolutely. And global inflation is a fascinating topic. I mentioned about the Fed changing the way they're thinking about inflation, having more of a movable feast around that sort of 2% medium-term target. They are intent to let it float around there. What does this mean in practice? So it potentially means that inflation-linked securities offer an investment potential. So you can have TIPS in the US, but obviously there are many others that you can look at across the globe. I caution the idea of inflationary pressure with what we have observed, for example, in Japan. Japan has struggled to introduce inflation into its economy over the years, as we've seen. But I think with the sheer scale of liquidity, with the sheer scale of fiscal stimulus, that we are in a much more opportune space to see a rise in inflation. What we need to look at is we need to look through the data. There are, broadly speaking, I would characterize it as two kinds of inflation, good and bad, if you will. Good inflation is where it is demand pull. Okay, so this is where consumers are spending. There is greater demand for goods and services. And of course, this then flows through the economy, and you would expect to see that in a GDP growth environment. Bad inflation is where you get cost push. So this is where the costs of goods and services are increasing because the input factors, the input costs are increasing, but it is not married with that increase in demand. And unless wages keep up with it, actually, you could potentially see a decline in consumer spending, which of course has been a key driver of GDP growth over the past decade.
Right, thank you. I think this is something that you and your team would be looking at closely. Now, I think we have questions coming in, so I want to make sure that we have enough time to cover the questions. So we have the first questions. Okay, so there's a question on outlook on preferred securities and US investment grade bonds. I think you talk about that a little bit, but I think maybe it's a good chance to just elaborate further on your views.
Yeah, absolutely. So, if we look at it from a shorter term point of view, as I say, we do continue to see the opportunity in developed and indeed US markets. From a more strategic point of view, we tilt those views more towards Asia, more towards emerging markets. That's from an equity point of view. Shorter term in investment grade credits and bonds, again, constructive holdings here, but we are watching cautiously. If we do see a deterioration in economic conditions, if we do see a slowing in the recovery, I think in all likelihood you will see spreads widening, and that will necessitate us to take nimble and effective action and potentially trim our exposures with a view to getting back in at better pricing levels. If I sort of tilt that view a little bit more and be specific in sort of Hong Kong and China equities, well, China, I think, remains a very attractive investment opportunity for us. And that would actually cover both fixed income and equities. Hong Kong, I think we've seen some good performance in equities of late. And I think selectively looking to add those kind of positions into the portfolios, but again, done through active management, done through bottom-up security selection. Hopefully that answers the question, Grace. Thank you.
Now, I have another question coming in. I think a lot of people have this question. I'm not sure if it's you have any views on that, but the question is, what's the potential impact of the US presidential election on asset classes?
Yes. Now, this is becoming the question that is being asked more and more. Typically, what you see is post-Labor Day, which of course was yesterday in the US, you tend to see an increase in the activity around the presidential campaigns. Look, the reality is that any degree of uncertainty typically creates a degree of volatility in markets. There's one thing that we've been looking at in particular to try and understand, what the impact of the presidential election would be, and just looking at option pricing on the S&P and volatility levels via the VIX. And what you actually see is that you have a hump in the volatility curve, so the VIX curve. And this is simply telling us that, the market is positioning itself for an uncertain outcome. The polls, I think, are very difficult to read, and we saw this back in 2016, where obviously the Democrats held a lead over Trump, but the end result gave a very different picture. I think in the coming weeks, we're going to understand more and more. I think the political rhetoric is going to increase. Trump is clearly building his campaign around what I would refer to as nearshoring, so bringing jobs, bringing manufacturing back to the US at the expense of the rest of the world. Also, we're waiting to see how things evolve with the US and China. Is there going to be additional tension there that comes out in any of the political campaigning? Now, one thing I would say, and our macro team have done some really interesting research on this, is looking at the impact on equity markets of Democratic versus Republican presidencies. And the results you might find a little bit interesting would seem to indicate, well, first of all, there is no concern, okay? And secondly, that in many situations, risk assets, equities in particular, have done better under Democratic presidents than they have under Republican. So there's a lot going on, as I say, and something that we are watching. The risk for me has been increasing over the past couple of weeks and is going to become more of a talking point and more of a factor that's likely to influence markets over the coming weeks.
So a little bit more noise in the market with the presidential elections coming up. So another live question, US tech companies versus Asia tech companies. Who will suffer more if the trade war or the tech war escalates?
That is a great question. Now, in an ideal world, what I would do is I would defer to one of our expert stock pickers, particularly in that sector. But of course, from a sectoral view and a sort of global view across asset classes, we do discuss these things. So, look, I think broadly speaking, at the moment, the US tech companies are running from strength to strength. Okay. Now, I think obviously Asia and China in particular has a huge base in technological advancements. Now, whether that is through the microchip side, whether it is through the social media side and all the other elements that are part and parcel of this. So you've got a kind of balancing act. Now, I think it's interesting to look at, what has happened to the prices and market capitalization of some of the larger companies. Having Amazon at over $2 trillion is quite extraordinary. If there is to be an escalation in the tech war, you are going to see more nearshoring. I actually don't think that it is obvious that there will be any one winner, one side or the other, because if you follow the argument through that it's going to be more nearshoring, if you look at, Donald Trump's comments and moves in relation to TikTok, well, you're actually reducing the global scope and span of tech companies and what they can and can't do. So it is going to be reducing market opportunity I think for all of them. Now, notwithstanding that, tech generally, as I've said, we are constructive on. We do see this as, how the economies are going to evolve, how exposures are going to evolve. And I also think it's going to be critical to watch consumer trends as economies reopen. Will people be returning to the high streets for consumer spending, or are we going to continue to see this dramatic increase and evolution in more online spending benefiting the likes of Amazon?
Right, thank you. Now, I just want to check if we have time for one more question. We have time for one more question. So we have a question coming in. So what do you think about the outlook of UK and European market in the coming few months? It seems like there's not a lot of productive discussion going on right now.
Yeah, look, and obviously being British and based in the UK, something very close to my heart. Look, clearly the noise and debate around any potential agreement between the UK and EU over Brexit has been increasing. We've seen over the last 48 hours that the UK government is, and I will say considering rather than pursuing, but considering putting into English law certain legislation that would arguably be in direct conflict with the withdrawal agreement, which that is effectively the divorce bill that was agreed with the European Union to allow negotiation of terms. Now, one sort of school of thought on this is that this is the UK government playing hardball, trying to get the EU to compromise on certain agenda items which are particularly relevant at home. The big sticking point, or one of the big sticking points, is overfishing, access to UK territorial waters. Now, from a sort of GDP point of view, it's small. From a political point of view, it's large, and that's on both sides. Now, the EU, of course, is unlikely to want Great Britain, the United Kingdom, to get a strong deal in exiting the EU, because one of the concerns that they've had is that, if the UK leaves and you actually see this as a good thing for the UK, that it might encourage further debate over the European model and ultimately leads to perhaps more referenda. It certainly isn't easy to get a good agreement. I think from a positioning point of view, sterling, of course, could come under significant risk, and we've already seen a lot of weakness, albeit a bit of stabilization and indeed appreciation over the past few weeks. From a European point of view, I think the big concern for the EU, aligned with, but slightly alongside Brexit, is the strength of the euro that we're seeing at the moment, because that's crimping their ability to generate positive GDP growth. And also from a sort of monetary and fiscal policy point of view, notwithstanding the recovery fund that's been put in place, how much ammunition do they have left from a monetary point of view? With interest rates already negative, you get into the realms of the more negative you go, the less effective they become. So those are the key things to watch there.
Thank you. Thank you. So I think I believe we have a lot of information from you. So once again, thank you, Luke, for joining us. I think we are reaching our time limit. So once thank you again, Luke, and thank you everyone who's out there joining us today for our asset allocation seminar. Thank you.
My pleasure. Thank you, everybody, for joining.